Let's bring to the conversation the Chief Investment Strategist at Blackstone, Joe Zidle. Joe, great to have you back here on a day like today. Do things, in your view, does your market outlook turn much dimmer and less optimistic after a day like today?
Well, I think clearly, number one, no one wins a trade war is point number one. And point number two is no one wins a currency war. So the risks are definitely elevated. But I continue to believe that we will arrive at some sort of an agreement with China. It's probably not anytime soon. My best guess is we don't see any sort of resolution to trade in 2019. So I think, for the rest of the year, we will see volatility. And my view is that the highs that we hit just a couple weeks ago will probably end up being the highs for the year. So I do think we'll see a more volatile and choppier market. But if you think about the markets, they sort of operate like a pendulum. The further you swing to an extreme on one side, you're going to swing back to the other side. And I think we're beginning to see that in the markets over the course of the last week and certainly today. So I think if there's a silver lining, it's that this is going to probably feel a lot like the period from September 12th of last year to December 24th, which is something that Guy just mentioned a minute ago. And in that instance, in the fourth quarter last year, we saw equities leading credit lower. And that's always, in my opinion, that is a classic false alarm when equities lead credit lower. And that's what we've seen again over the last week. Equity markets have fallen far more than credit spreads had widened out. That tells me that this is still in the financial markets, which means I think it will just lead to buying opportunities.
So your price target for the year is $28.75. 4 sectors that you're recommending. 2 of the sectors are extremely exposed to trade war and currency impact, industrials and materials. How do you get your head around saying that we have got limited upside in the S&P 500? Oh, this trade war could get worse, and yet we want people to be in these 2 sectors.
I think as we put together our buy list, it would be those global cyclicals. It would be those companies that are exposed to consumer discretionary. And the underlying reason behind all that is that I don't think this is the end of the economic expansion. I don't think our economic expansion is going to end with a trade war or with these sorts of policy mistakes. So I see this as a mid to late cycle pause where we do see volatility, but I still think this is an economic expansion that can go on for years. And again, the base case is that we do get some resolution to trade with China. Granted, the currency escalation, it's a big risk. You can't ignore it.
So you bring up credit markets, which is really important because they kind of, maybe they're weakening a little, but not a lot, right? So if you say credit follows equities, that's a mistake. What then makes credit unravel, if not equities? Right? They don't just unravel in a vacuum.
No, I think you raise a great point. And there's the difference between an equity investor and a credit investor is this. When you're investing in equities, you're generally thinking about quarterly profits, you're thinking about cash flows, and equity investors tend to get really geared toward quarterly profits or the profit cycle, whereas credit investors are primarily concerned with return of principal, right? Return of, are they going to get their money back? So as a result, credit investors tend to get more geared toward economic cycles. And so the reason why we're seeing credit hanging in there is because there's this view that this is not the end of an economic expansion. What would cause credit to unravel, in my opinion, is if we are facing the end of an economic expansion, if we're facing the beginning of the next recession. I don't think we're anywhere near there yet. Our view is we don't see a recession until the year 2021 at the earliest. And I think this is a cycle that could even go on longer than that.
Well, you're talking about whether or not this is a currency war or currency crisis. I mean, at this point, if it is, let's say, a war, we've only got China firing the one shot on its side. If the U.S. does try to intervene to the best of its ability, I mean, we don't know if it really has the firepower to do so. But if it does that make your market outlook worse?
I think it would. And there's a couple things to consider, right? Number one, it's China versus the U.S., which we saw today. But at the same time, it's South Korea versus Japan, where the Korean won plunged to basically 3-year lows against the yen. And at the same time, the countries have removed one another from favorable export treaties. They've curbed imports, things like that. You also have to consider the possibility of the U.S. versus the dollar versus the euro. That's something that President Trump has talked about. There was supposed to be a bipartisan bill introduced into the Senate last week that would have effectively forced the Treasury to devalue the currency. Congress is now on recess. It's not unlikely that's going to go anywhere, but I think it does represent, or it's symptomatic of that underlying tension that's there. So again, these things are all risks, and you don't win a currency war just like you don't win a trade war. So if they spiral out of control, it's a risk. What I would watch to consider whether these risks come to fruition or not is CEO confidence. We've seen it roll over. If CEO confidence continues to fall, then you can forget about CapEx, and you can forget about hiring.
Joe, great to see you. Thank you.
Thanks for having me.
Joe Zidle, a.k.a. Jay-Z here on
Jay-Z's the man.
I like it.
Guy, go to you. September's a very important time for a lot of CEOs.
Yeah.
That's when they decide what money to spend, what plans to build,
And
things
think
like
about
that.
think about the backdrop that they're looking at right now in terms of everything Joe said, everything we've been saying for the last 15 minutes. It's not all that encouraging. If you're at home and trying to figure out this whole high yield thing, it's not a perfect instrument, but put HYG on your screen and watch that. It closed today only down 1%. To Joe's point, it wasn't a disaster. And I'll say this quickly. You better hope it's a currency war and not a currency crisis. And again, a distinction that BK made, because if this is a crisis, and I say it all the time, you're going to walk in one day, gold's going to be up $100, everybody's going to discount it. It's going to happen for the next 3 days in a row. That's really what we should be concerned about.